A gap is simply an area on a chart where no trade takes place. In general, this phenomenon occurs when market closes for the day and opens next day again. The gaps generally occur when the market is about to make or end a major move. Gaps can get formed by several factors such as tremendous buying or selling pressure, a changing rating, earnings report, or any other type of news release. Such factors could result in the price opening higher or lower than the previous day's close. Now, there are four basic types of gaps and they are distinguished by their placement on chart. Breakaway gaps occur at the completion of a price pattern and usually signal the start of a significant price move. Or else, they occur when the price action is breaking out of their trading range. They emphasize breakout, and the signal is even stronger when it occurs with higher volume. At breakout, market opinion has shifted by large and is a very powerful indicator. Now, continuation gaps. Now, once a rally or decline is underway, and when the majority of participants think a market will continue its move, the market simply jumps to new price immediately, and this phenomenon results in continuation gap, also known as measuring or runaway gaps. Now, these exhaustion gaps occur near the end of the move to signal a last push towards new high or low. It is sometimes difficult to identify this type of gap because it appears like a continuation gap. Now, these continuation gaps are followed by strong trend, whereas exhaustions are followed by congested sideways market action. And finally, common gaps occur within price patterns or congestion zones and are the least meaningful of all gaps. They signify a lack of direction in the market. Okay, let's get this concept of price gaps clear. So we have an index chart here. This index has been consolidating for a while. This region over here is clearly a strong resistance zone. Price resists here and so does here. Suddenly and remarkably, price breaks out with a gap. So we classify this as a breakaway gap. This variety occurs and works best when the price breaks out of a congestion area or any chart pattern that we have discussed earlier. Volume is extremely important here. Oops, I failed to attach volume information here. But anyways, so volume should pick up significantly if this is believed to be a true breakaway gap. There can be two reasons behind increase in volume. Number one, it showcases increased enthusiasm. And number two, traders, by large being amateurs, are holding positions on the wrong side of this breakout and need to cover their short positions quickly. Traders may have created short position here again, anticipating market to reverse that will head for south. But they got themselves trapped and must bail themselves out quickly. They have no option than to liquidate shorts quickly. Let me tell you something vital here again. If gaps occur with classic chart patterns, be it head and shoulders or triple tops bottoms or triangles or any other pattern, then it has a higher probability of success. Now, this chart that we are examining does have a rectangle in place, and this pattern breaks out of the gap to the upside. Is no doubt a much better, higher probability breakaway gap to trade. Market keeps heading higher, and now we have this gap over here. This one is a continuation gap, also called runaway gaps or measuring gaps. Now, this gap is by large caused on account of increased interest in the stock. But it may also be backed by some important and positive news announcement or development that caused this new interest in the stock. But how far the price is going to travel? it is generally noted that this gap will occur halfway through the move. So this has been the movement on the occurrence of breakaway gap, and that would mean we are only halfway through. Remember that this is no rule, it's been generally observed. Now this market continues to be strong, and now we have a gap here again. But standing here, we really do not know if it's a running gap or going to be an exhaustion gap. But exhaustion can be identified interpreting how high the volume is and where the closing price is. Also remember, after already having witnessed a runaway gap, chance of having another successful running gap is remote. So if this has to become an exhaustion gap, then the volume has to be exceptionally high on this day than the preceding candles, and closing must be at the lower end of the trading range. Now we do not have volume information at the moment, but yes, closing is indeed in the lower half. Rather, it closed almost lowest for this day. The exhaustion gap gets quickly filled, as is the case here, and prices reverse their trend. Now before we close this discussion over gaps, there is one more thing to reveal, and it's vital. Always remember that high of an exhaustion gap is stiff to break. It's a pretty stiff resistance. I do not mean spiking through the high of exhaustion gap making candle bar, but closing above this mark. This case study on gap in itself presents you this phenomenon. See how price makes an attempt to rally past the highs, but fails, encountering this exhaustion gap making candle, and heads lower and eventually making a new low. And yes, we have common gaps here. A common gap occurs during congestion period and is of no relevance and must be ignored all the time. They have no utility at all.